Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the first Cut to the Chase podcast in 2026. Today is Friday, the 2nd of January. I'm Daniel Lam, and I wish you all a very successful new year. In 2026, we continue to be overweight global equities, especially those in the US and also in Asia ex-Japan. Investors' focus will still be on the US technology sector and AI-related stocks. So for this first podcast of the year, I will lay out our view on this key focus area. The way we see it is that the path for AI-related capital expenditure, i.e. CapEx, is going to be higher for longer. We see massive capital commitment, long-dated project pipelines, and broadening economic impact not only in the US, but also in Asia and in Europe. This is a structural shift in the technology landscape rather than a short-term investment cycle. Now, Bloomberg Consensus projects the four major hyperscalers to spend a cumulative capex of around $350 billion in 2025. That's up 64% year over year, following a growth rate of up 39% in 2024. Now, from the latest earnings season, guidance from this group points towards further increases in capex over the near term. The growth rate may moderate to around 40% in 2026, but the absolute investment scale is still massive, at approximately $500 billion in 2026 and $580 billion in 2027, alongside monumental projects such as the Stargate initiative. AI capex investments is not limited to data center alone. It also extends to the entire supporting ecosystem. So if you recall, in 2025, we have been positive on the prospects for AI infrastructure-related stocks. In 2026, I want to highlight areas such as energy and utilities for power generation, as well as for cooling systems. Now, the recent Genesis mission, launched by the US government to transform science and innovation through the power of AI, further expands the use of artificial intelligence. This underscores the multi-year horizon of these commitments. Now, there have been concerns, particularly towards the end of 2025, that hyperscalers would need to be taking on debt in order to fuel their investments. However, in most cases, free cash flow is still abundant for the major tech companies. Strong demand-side fundamentals is still justifying the capital spent, with hyperscalers reporting strong growth in AI-related revenues over the past quarters, significantly outpacing their capex growth rates, with bright prospects ahead. The structural trend in AI provides the backbone for equities to be going higher in 2026. Yes, there will be noises and volatility at times this year, but we would advocate investors to be adding on pullbacks, especially on US technology stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.